Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Bitcoin's brick wall. BTC's attempts to break out with TradFi flows are suppressed by enormous sell pressure from BTC whales. What this means for the crypto market.
Ethereum's on-chain boom. Gas fees explode due to hype around a new token standard, while liquid restaking causes a DeFi resurgence. When will ETH hit 3K?
Fed versus stablecoins. Chairman Jerome Powell pressures Congress to pass stablecoin regulations as another Fed governor contemplates their role in USD dominance. Everything you need to know.
Billionaires sell stocks. Amazon founder Jeff Bezos sells over $6 billion of shares in a single month, leading to speculation of a coming market crash. Why are so many billionaires selling shares?
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, BTC tried and failed to break 53K on multiple days. According to Cointelegraph, this was due to a, quote, brick wall of sell orders by BTC whales on exchanges, namely Bitfinex. Put simply, big BTC holders appear to be taking lots of profit around 52K, preventing BTC from exploding to the upside. At the same time, inflows into the spot Bitcoin ETFs have continued to grow, with net inflows totaling over $2 billion. So this begs the question of how much more BTC these whales have left to sell. The answer is that nobody knows, but if the ETF inflows continue, these whales will eventually run out. The caveat is that these BTC whales aren't the only sellers around. As you may have heard, bankrupt crypto lender Genesis was recently given approval to sell $1.6 billion of GBTC shares to repay creditors. It's not clear when this sell pressure will come, but it will likewise offset ETF inflows. At the same time, bankrupt crypto platform Celsius has reportedly refunded creditors. This refund includes $1 billion worth of BTC, some of which could be sold. Again, it's not entirely clear when this sell pressure will come, but it could likewise offset ETF inflows in the short term. In sum then, we could be looking at another week or two of BTC sell pressure offsetting the buying pressure coming from spot Bitcoin ETF inflows. The caveat in this case is that these inflows are likely to increase as more investment advisors begin offering these Bitcoin ETFs to their clients. Logically, this means that BTC's price will eventually break free of any incoming sell pressure and rally up to 55K and beyond, as many are expecting. Until then, though, BTC will likely trade sideways around 52K. Now, to be honest, the charts don't provide any useful guidance here as there are no clear patterns in sight. Zooming out to the weekly reveals that 52K is a key resistance level from the previous cycle top. BTC's market cap being at around $1 trillion is also likely serving as a psychological barrier for some traders. A clean break above this resistance would take BTC to 55K, whereas a rejection would take it down to 50K. Zooming out to the monthly, meanwhile, reveals that BTC is squeezing to the upside per the Bollinger Band. As you can see, the last time this happened was at the start of the previous crypto bull market. Getting a crypto bull market this early in the cycle would be unprecedented, but it appears to be happening. Now, if you're trading BTC, then be sure to check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $50,000 on the best crypto exchanges. These deals are available for a limited time only, folks, so take advantage of them before it's too late using the link in the description. Now, the silver lining to BTC moving sideways is that it creates the perfect conditions for altcoins to pump. This can be clearly seen on the ETH BTC chart, which started creeping to the upside last week. If BTC continues to trade sideways, then this trend is likely to continue and foreshadows ETH strength. This would not be a surprising outcome considering that Ethereum has no shortage of upcoming catalysts which are slowly coming into view. By now, you'll all know that these include spot Ethereum ETFs, as well as the Denkun upgrade, which is scheduled to occur in early March. As it so happens, ETH's daily chart appears to be in the process of painting a bull flag, which could take ETH up to 3K or higher in the next couple of weeks. I'll quickly note that the weekly chart suggests that ETH could stall at around 3.3K, similarly to how BTC has been stalling at around 52K. The difference is that ETH whales have already been selling for some time. Some of you might recall all of the headlines about ICO-era wallets suddenly awakening and sending their ETH to exchanges. Even Ethereum co-founders such as Vitalik Buterin and Jeffrey Wilker have sent ETH to exchanges in recent months. It's safe to say that these apparent ETH sales have raised a few eyebrows, but it's important not to lose sight of the other activity that's been happening on-chain. For example, Ethereum's validator queue is starting to fill up, suggesting that the interest in ETH staking is starting to rise significantly. The catch is that this increase in ETH staking is likely a byproduct of all the excitement around restaking and liquid restaking. Without getting too technical, restaking involves using staked ETH or liquid staked ETH to provide security for additional blockchains. This allows ETH stakers of all kinds to earn extra yield. Now, as the term suggests, liquid restaking makes it possible to effectively tokenize this restaked ETH so that it can be traded and used in DeFi protocols. Now, until recently, liquid restaking had been limited due to the caps that EigenLayer had set on its restaked ETH protocol. Well, these caps were temporarily lifted, and the result was that EigenLayer became the fourth largest DeFi protocol by market cap, driven in large part by liquid restaking protocols like Puffer Finance finally being able to stake ETH to mint their liquid restaked tokens. This, combined with the ERC 404 craze, has caused gas fees on Ethereum to spike. We'll be doing a video about ERC 404 very soon, so stay tuned for that. But while you wait, you can check out our recent video about Denkun so that you know what to expect when it comes around in early March. The link will be in the description. Now, if all of this restaking stuff sounds risky, that's because it is. We recently reviewed one of these liquid restaking protocols for our Coin Bureau Club members, and our conclusion was that these protocols, although promising, consist of risk built upon risk built upon risk. But hey, as the saying goes, no risk, no reward. Risk upon risk is the price you pay for potential double-digit yields. On that note, another crypto niche that's been earning lots of yield lately is stablecoins, specifically stablecoin issuers. As most of you will know, most of the stablecoins in circulation are backed by US government debt, which has been earning a sizable yield thanks to higher interest rates. The result has been mind-blowing profits for stablecoin issuers such as Tether and Circle, who are essentially earning billions of dollars of passive income on the reserves for USDT and USDC, respectively. As their market caps have continued to grow, so too have their profits and their holdings of US bonds. Now, the fact that stablecoin issuers collectively hold close to $150 billion of US government debt has made US authorities rather nervous. At first, they seemed to think that a crackdown was the best way to go. As stablecoins continue to grow, however, it seems they're starting to realize that a crackdown presents a big risk. This would explain why Federal Reserve Chairman Jerome Powell is reportedly pressuring Congress to pass stablecoin regulations. For context, Congress has been trying to pass a stablecoin bill for over 2 years. Recent reports suggest that this bill is close to becoming law, but it could still be a few months before it is officially implemented. Now, this is a scary situation for the Fed because the stablecoin industry has grown to the size that if there were to be any problems, it could very well have a knock-on effect on the rest of the financial system. This could force the Fed to step in and stimulate, which is the last thing it wants to do right now. Other Fed governors, such as Christopher Waller, seem to be seeing the brighter side of stablecoins, however. He recently remarked that 99% of stablecoins in crypto are backed by the US dollar, so any increase in crypto-related activity, including trading and DeFi, could further boost the USD's global status. It goes without saying that the original purpose of crypto was not to boost the USD's global status, but many would argue that this is a necessary step towards crypto realizing its goal of replacing the traditional financial system and all its faulty fiat currencies. Feel free to leave your thoughts on the matter below. Now, the key takeaway here is that the Fed is starting to see stablecoins in a different light. As just mentioned, their initial approach was to crack down on stablecoins. Today, they're trying to regulate them and possibly even promote them, as they could indirectly help them achieve their unstated USD-related goals. Just remember, though, that the Fed isn't the only regulator who's been dealing with stablecoins. The Treasury Department has also been involved, as has the SEC. Now, whereas the Treasury seems to be on the same page as the Fed, the SEC still seems to think that stablecoins are somehow analogous to shares in a company. Speaking of which, some of you may have heard that billionaires have recently been selling billions of dollars worth of shares, which is unprecedented. For reference, billionaires often borrow against their assets instead of selling them, because that way they don't have to pay tax. The more you know. Now, the fact that billionaires have been selling their assets rather than borrowing against them is therefore very significant. Take Amazon founder Jeff Bezos, for instance. You might recall that he sold no less than $6 billion of shares this month. Now, the official story is because he's relocating to Florida or whatever. But when you realize that the last time he sold Amazon shares was back in November 2021, you start to wonder whether there could be more to this story. To refresh your memory, the markets were hitting their peak in late 2021. And some of you might remember that Elon Musk sold lots of Tesla shares around this time too. And it's not just Jeff either. Meta CEO Mark Zuckerberg also sold around $500 million worth of shares late last year. Around that time, reports started to emerge that Mark was building a $270 million bunker in Hawaii. Now, perhaps we're mistaken, but these two events seem to be related. The most eye-opening sale of them all, however, came late last year from JP Morgan CEO Jamie Dimon, when he announced that he would be selling $140 million worth of shares starting this year. This was the first time Jamie had sold shares in the bank. Note that the banking system is a bit wobbly in the United States at the moment. Now, this puts all the selling by BTC whales and ETH insiders into perspective. It stands to reason that all these wealthy investors wouldn't be selling if they believed that the markets would continue to rally. Then again, it also stands to reason that they would take some profits. It's arguably a part of why they're wealthy in the first place. Even so, when you look at the charts for, say, Amazon, you'll notice that it's bumping up against a key resistance level on the weekly and actually saw a bearish weekly close last week. Looking at stock indices like the S&P 500, you'll notice that they've basically gone vertical and can't possibly keep rallying. But that's where you'd be wrong. As the saying goes, the markets can remain irrational longer than you can remain solvent. And this is especially true when it comes to stocks, since a large portion of inflows comes from automatic buying based on market cap, resulting in large cap stocks, well, going vertical. What this means is that stocks and even crypto could continue to rally indefinitely. For stocks, it's going to require some kind of paradigm shift to turn the automatic buying into selling. This could be anything from interest rates staying higher for longer to a geopolitical change that alters market fundamentals. For crypto, it's likewise going to require some substantial crypto-related shock to take the wind out of its sails. That's just because the crypto market tends to be the most forward-looking. Any macro disruption would be priced in, with investors then pricing in the stimulus, just like with the banking crisis last year. However, a crypto-related disruption could be harder for the markets to overcome, mainly because it would create a lot more uncertainty in terms of a response. After all, everyone knows the central banks will bail out the commercial banks and the stock markets, but it's very unlikely that they would do the same for crypto. And with that said, it's about time we looked at last week's top-performing cryptos. So, Jessica, the floor is yours.
Thanks, Guy. Well, last week's top-performing cryptos were the BitGet token, SEI coin, VeChain, SEI, and Arweave. Starting with the BitGet token, we actually couldn't figure out why BGB had pumped. Our best guess is that it was due to an increase in traded volume on the BitGet exchange, given that BGB is an exchange token. As you can see, BGB's price has gone parabolic over the last month. Believe it or not, but it appears to be painting a bull flag that could take its price much higher in the short term. Just remember that exchange tokens tend to have tokenomics that cause them to pump and come with their own share of risks. Next up, we have SEI coin. SEI appears to have pumped due to the release of a development update and roadmap for the decentralized storage project. As you can see, SEI's price has also gone parabolic, but it's been very volatile lately. This makes it hard to analyze its price, but it's clearly in a long-term uptrend, and that's what matters. As for VeChain, its VetCoin appears to have pumped because of the UFC fights over the weekend. For those who don't know, VeChain became a UFC sponsor back in 2022. As you can see, VET has experienced an explosive rally over the last month. Assuming the pattern in progress is a bull flag, then VET still has more room to rally before hitting resistance levels from the previous bull market. When it comes to SEI, its SEI coin appears to have pumped on the news that its novel parallelized EVM is one step closer to launching. Note that we did a video about SEI for our CoinBureau Club members. You can find the details in the deals page using the link in the description. Now, as you can see, SEI appears to have broken out of a bull flag of its own. The difference is that SEI is a brand new crypto, so there aren't any key zones of resistance to use as reference. A good rule of thumb is to watch out for psychologically significant price levels, in this case, $1.50 and $2. Last but certainly not least, we have Arweave, whose AR coin appears to have pumped on the release of the project's so-called Universal Data License, which allows people to include or exclude their content from AI data training. Very cool. Like SEI, AR's price action has been a little bit bizarre, but is likewise in an uptrend. Unfortunately for AR, it faces quite a bit of resistance around the $14 level. Fortunately, the AI hype combined with Arweave's solid fundamentals could be enough to get it above the resistance range. And if you want to know why cryptos are pumping and also where you can trade them, be sure to check out the CoinBureau Insider Telegram channel. The link will be down in the description.
And that's all for today's CoinBureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $50,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you want to pick up some snazzy crypto merch, the CoinBureau merch store has it all.
You can find the links to those resources and many others in the description below.
Thank you so much for watching, and we'll see you in next week's episode.